Hello, everyone. Once again, I am Raj Malhotra, ITPM Senior Trading Mentor. So it seems that the narrative that has taken hold of the market in the last month or so is fears of higher for longer. Now, of course, when I'm talking about higher for longer, I'm referring to the Fed and their changing narrative on rate cuts, which the market now expects to be delayed or even totally eliminated for 2024. As opposed to what's going to happen to most high school kids should Biden's proposed federal marijuana legalization pass. But in all seriousness, when assessing these type of events like higher for longer, it's important to look at expected correlations and its effect on other assets, and then what actually happens. So as you can see here, the 10-year Treasury rate started the year around 3.86 and stayed under 4% for most of January, on expectations of around 5 or 6 rate cuts for 2024. So if you've been following me, very early on, I argued that this was way too aggressive for the market, unless we get a recession or a big economic slowdown, which just hasn't happened. And at this time, I still don't expect that to happen. However, the move on the 10-year above 4.6 from 3.85 or so, it should have been especially jarring to certain segments of the market, such as long duration stocks like small caps and unprofitable companies. For example, names that are held in ETFs like the ARKK. To be quite honest, the broader market holding up this well has been very surprising to me in this backdrop. I mean, it's held up for now, but we'll see it going forward. But even with a move in these rates, with the S&P up 6% or so year to date, that is something that few of us would have expected if I told you beforehand that the 10-year would be sitting 75 basis points higher in yields right now versus for where they were at the beginning of the year. You know, historical correlation tells us that these moves like this in rates, it should have led to a big drawdown in the stock market, which just hasn't happened yet. However, that's not the only surprise, and some of them are actually even more surprising to me. Some other classic correlations that have been very strange and had some really surprising relative moves. One of which is the correlation between gold and bonds. Bonds and gold historically move together. That means is that gold prices go up, bond prices go up, and since they're inversely related, bond prices go up, yields lower, or vice versa. And vice versa, bonds go down, gold goes down, and yields go higher. But that hasn't happened here at all. In fact, it's been the complete opposite. Gold is up about 20% over the last 6 months, and bonds are down about 10% over this same period. Now, this approximately 30% divergence is one of the largest in recorded history. And I've been struggling to find a good explanation for why this has happened. You'll hear rumors on Twitter of central banks buying gold, but that's all nonsense because that alone isn't enough to justify this divergence. You know, even the move in the relative move between gold and stocks has been very surprising. So gold is up about 15% or so year to date, and about 21% in the last 6 months, which is more than double the return of the S&P. Now, it's very rare to see both of these higher. However, gold with a significantly higher return than equity prices. If you look at historic correlation and historical volatility, historically, gold is a much less volatile asset. So if the market's up, you would expect gold to be up, but not that much. Quite honestly, you would expect the S&P to double the gold returns. Not what's actually happened. The only time you generally see gold outperform stocks is in a risk-off environment. Because what happens in a risk-off environment, gold gets bought because it's a safe haven and stocks sell off. But this clearly has not been a risk-off environment. It's clearly been a risk-on environment, especially if you look at the price of anything that's been volatile, like semis, anything AI related. You know, Bitcoin and other crypto, baseball cards, housing, any of that stuff. It's pretty clear in the last 6 months, give or take the last week or two, risky assets have been bought aggressively, not sold. So gold is clearly ignoring the higher for longer interest rate environment. So why is there this global gold rush when we are on track for this soft landing? To me, something isn't adding up, and I'm trying to figure it out. So what does this mean going forward? Well, if you've been following me, I'm not surprised by the move in gold or other commodities because I've been pretty bullish on commodities. To me, when I look at fundamentals, it tells me that there are still good long end candidates in metals besides gold, like copper, uh, energy, industrials, aluminum, steel. And I've been consistently saying that I expect for 2024 for the market rally to broaden out, which is basically what has happened so far. And that has been my base case. However, these correlations breaking down have really given me pause to my central thesis. Because when I see correlations like this break down, what often follows that is a total risk off trade. And a risk off trade means lower equity prices. This small correction here is certainly not a risk off trade yet. However, if we do have a risk off trade, that will almost certainly mean lower equity prices and possibly higher gold prices and higher bond prices. But again, these correlations have been thrown out the window, so it's given me a lot of pause here. So let's say that my base case is just wrong, that and equity prices either are flat or lower from here. Well, that's okay because I'm always looking at building a balanced portfolio, and I'm always looking for that so I have the potential to be profitable no matter what the market does as a whole. So today I want to focus on sectors where money could flow out of, given my view, which could be right or wrong, and I would be right either way. So I think if you're too long or you feel too long, it makes sense to buy put spreads in bigger cap tech or even broad-based ETFs as a hedge, or you just want to balance out your portfolio. Because I've said it and I will say it again here. I don't believe that broad tech is the place for outsized returns in 2024 the way it was in 2023. You've already seen weakness in Apple and Tesla in particular, and to me that seems likely to continue. Now, I'm not going out and telling you to go short NVIDIA or other stocks with real pricing power. Because even in a slowdown, you want to be long names with pricing power no matter what the sector. However, any names without pricing power are going to be very vulnerable right now, and I feel like that going forward. Because to me, this recent AI boom reminds me a lot of 1999. Now, I am clearly not saying that we are in a bubble, anything like we were in the tech bubble of 1999. Valuations are nowhere near they were back then. And I want to reiterate that point clearly, that I'm not saying we're going to have a crash like that because those valuations were astronomical. Back then, for those of you that weren't around, you could just add .com to your company name and your company would be worth 50, 100 billion overnight. But what I am saying clearly are that there are certain tech stocks that rallied higher simply by claiming to be an AI beneficiary, when in fact they are not. And that's when you're supposed to do your homework. Because to me, similar to the stocks that rallied in 1999, back then, certain .com names just rallied for no reason. And to me, there are clearly AI names that are out there that are going to be worthless, but those are very hard to find. And that's not really where I'm looking, and most of you should probably look. So what I'm basically looking for is the next Cisco. Let's look at a long-term chart of Cisco here. So from 1998 to 2000, Cisco rallied around 700% from there to its peak. And today, 24 years later, Cisco trades at half of its all-time high. So, and remember this, Cisco was still a real company. Cisco was not pets.com. Cisco is a real company, and they're still around and have a real business. But the problem with Cisco was it rallied very hard and ultimately came down a lot because eventually the market realized that Cisco wasn't as important to the internet as some initially thought. Once people did their homework, the market realized there's a clear separation between names like Cisco and Amazon. So again, there are going to be companies that are going to be clear winners from AI. If the market goes down, these AI names will go down. NVIDIA will probably go down. But if you believe in AI, NVIDIA clearly has a seat at the head of the table. So instead, I'm looking for names that lack any real substance to AI, but saying they're AI businesses. Because remember this, even if this is just a correction and the market continues its rally from here, these second-rate tech names will still lag. However, if the broken correlations like I've highlighted are start of a slowdown or even worse, a recession, then these fake AI names with little pricing power could get cut in half. So one example of a fake AI name could be Adobe. If you, as you can see here, the market might be starting to realize it. The stock is down 18% year to date, with the rest of the market still up. However, looking backward, it still has outperformed the S&P over the last year. So there is definitely more room to the downside. So while the company is trying to tell the market it's a beneficiary of the AI trend, I just don't see it. Its plan to make money is like a Chinatown Rolex. It's just not real. It's a fake. I'm not going to do your homework and tell you all the data points I've researched. However, I will say that anytime they're asked on how they're monetizing AI, they just put out generic statements, which gives me, which sends my radar up as this is false. What they're saying, they're saying nothing concrete, it's just fluff. So if the company has no growth in AI, which is what I believe, what about its core business? Well, if you look at their core business from the last earnings call, they guided down for Q2. Growth companies should never lower forward estimates. That's how they become dinosaurs like Cisco. Adobe might still have a decent enterprise business, but that's the IBM model, and that's just not exciting. So you're also starting to see cracks in the business segment. If you see more cracks in their next earnings calls, it's coming up in May, that could absolutely punish Adobe. So again, I don't think the stock is going to zero like Cisco, but if any of these challenges I mentioned become more apparent after the earnings call, this could easily have a 20 to 30% sell-off pretty quickly. The market breaks down to maybe twice that. So looking here, the stock's reporting, post June expiration. I'm looking at the June 370, 470 put spread. It cost around $22. If the stock sells off 20%, you make a 3.5 to 1 payoff. So in summary, looking at these classic correlations breaking down has me very worried. I'm not overly bearish yet, but I'm definitely cautious. Of course, that can change, so monitor how assets move versus each other and if it makes sense. And if it doesn't, get even more cautious. With that, I'm Raj Malhotra. See you all soon. Thank you.